Ladies and gentlemen, let me start with a question that might make you uncomfortable. What if the next economic crash isn't your downfall, but your breakthrough? History doesn't reward the loudest crowd or the most confident headlines. History rewards the prepared. And today, I want to show you why the so-called 2026 crash could the single greatest wealth, building opportunity of your lifetime, if you have the courage to see it differently. Every major fortune you admire was built during chaos. The Great Depression created generational wealth. The 2008 financial crisis minted new billionaires. The pandemic crash reshaped entire industries overnight. Crashes don't destroy money, they transfer it. And the uncomfortable truth is this: money doesn't disappear in a crash, it simply moves from impatient hands to disciplined ones. Here's the hook most people miss when markets are booming. Average investors feel smart. When markets crash, smart investors get rich. Fear floods the streets, prices collapse, and assets go on sale. But only those who planned ahead can buy them. The masses panic, sell, and retreat. The few who studied history step forward and build wealth while headlines scream doom. Now let's talk economics, not emotions. Asset bubbles inflate when easy money flows and discipline disappears. Eventually, debt tightens, liquidity dries up, and markets reset. That reset is not punishment, it's correction. The 2026 crash, whether triggered by debt cycles, interest rate pressure, or global instability, will do exactly what every crash has done before: strip value from hype and return power to fundamentals. This is where opportunity lies. Stocks of real companies fall below their true value. Real estate prices soften while long-term demand remains. New technologies survive the shakeout and emerge stronger. Wealth is built by those who understand intrinsic value and have the patience to wait while others rush for the exit. But let me be very clear, this is not about gambling. This is about preparation. The crash will not make you rich by accident. It will only reward those who educated themselves early, built liquidity, controlled debt, and developed emotional discipline. If you show up unprepared, the crash will hurt you. If you show up ready, it can change your bloodline. Here's another uncomfortable truth for many people. This may be the last major wealth transfer of this scale in their lifetime. As markets mature, access tightens, automation accelerates, and competition increases, opportunities like this become rarer. Missing it won't just be a missed profit, it will be a missed era. Economic crashes are often misunderstood as periods of destruction, but in reality they function as large-scale mechanisms of wealth transfer. When markets collapse, money does not vanish from the economy, it changes ownership. Assets that were once overpriced due to speculation, excessive optimism, and easy credit suddenly repriced to levels far below their intrinsic value. In these moments, fear replaces confidence, and emotional decision-making dominates rational judgment. This shift creates the conditions under which wealth moves from those driven by panic to those guided by preparation and discipline. The first hook most people fail to recognize is that market crashes punish behavior, not participation. Investors who chase momentum during boom periods enter markets at inflated prices, often using leverage and short-term thinking. When conditions reverse, these participants are forced to sell, not because the assets have lost long-term value, but because they lack liquidity, patience, or emotional control. Forced selling accelerates price declines, pushing valuable assets into the hands of buyers who were waiting for exactly this moment. Another critical dynamic at play is asymmetric behavior between buyers and sellers. During crashes, sellers act under pressure, while buyers act by choice. This imbalance shifts bargaining power dramatically. Prices fall not because assets become worthless, but because urgency floods the market. Those who understand this dynamic recognize that volatility is not risk in itself. The real risk is being unprepared when opportunity appears. History repeatedly confirms this pattern. Every major downturn has followed the same script: widespread fear, collapsing prices, mass exit, and then a silent accumulation by a minority who understand long-term value. These accumulators do not rely on predictions or headlines. They rely on balance sheets, cash flows, and economic fundamentals. While the crowd focuses on losses already incurred, disciplined investors focus on future returns yet to be realized. The emotional gap between fear and opportunity is where wealth changes hands. Most individuals experience crashes as personal failure because they associate falling prices with loss rather than with access. Prepared investors view the same environment as a temporary discount on productive assets. This difference in perception, not intelligence or luck, explains why economic downturns consistently create new fortunes while wiping out unprepared participants. The final hook is uncomfortable but essential. Wealth transfer during crashes is not accidental or unfair, it is structural. Markets reward patience, liquidity, and rationality, and penalize overconfidence and short-term thinking. Those who recognize this reality early do not fear crashes, they anticipate them. They understand that the greatest financial opportunities rarely arrive with comfort or clarity, but with uncertainty, silence, and the courage to act when others cannot. Economic crashes are rarely sudden events, they are the inevitable outcome of debt cycles reaching their breaking point. Periods of prolonged growth encourage borrowing, as low interest rates and abundant credit create the illusion that leverage is safe and limitless. Businesses expand aggressively, governments accumulate deficits, and households take on obligations that appear manageable under stable conditions. The hook most people miss is that prosperity itself often plants the seeds of collapse, because debt grows faster than the real economy's ability to service it. As interest rates rise or credit conditions tighten, the system begins to strain. Cash flows that once covered obligations with ease start to narrow, and refinancing becomes more expensive or unavailable. Liquidity, which once flooded markets, quietly retreats. This shift does not cause immediate panic, but it steadily reduces flexibility across the economy. The moment liquidity contracts, risk is repriced, and leverage positions that relied on constant access to cheap capital become vulnerable. The real turning point in debt-driven downturns occurs when leverage meets immobility. Assets financed with borrowed money lose value, but the debt attached to them remains fixed. This imbalance forces asset sales, not because owners want to sell, but because they must. Forced deleveraging accelerates price declines and spreads stress across markets, turning isolated weaknesses into systemic events. This is when crashes stop being theoretical and become visible to the public. Here is the critical hook: liquidity is not just money, it is timing and choice. Those with access to capital can wait, negotiate, and acquire. Those without liquidity lose optionality and are pushed into unfavorable decisions. During a contraction, the economy does not slow evenly, it fractures along lines of leverage. Cash-rich participants gain influence, while debt-heavy participants lose control, regardless of their past success or reputation. Debt cycles also reshape power structures within the economy. Institutions with strong balance sheets survive and absorb weakened competitors. Investors with patience and reserves step into markets where competition has vanished. Prices reflect distress rather than value, creating conditions where long-term returns are amplified once liquidity eventually returns. This is why the most attractive opportunities emerge when capital feels scarce and confidence is lowest. The deeper lesson is that crashes are not failures of capitalism, but corrections of excess. Liquidity contraction enforces discipline where abundance encouraged recklessness. Those who understand this dynamic do not fear tightening conditions, they respect them. They prepare by reducing leverage, strengthening cash positions, and studying fundamentals long before the cycle turns. When the contraction arrives, they are not scrambling for survival. They're positioned for influence, control, and long-term wealth creation, while the rest of the market is still asking what went wrong. During economic downturns, markets stop behaving like calculators and start behaving like crowds. Fear overrides analysis, and emotion replaces logic. This shift causes assets to be priced not according to their underlying value, but according to urgency and uncertainty. The hook here is simple but powerful. Prices fall faster than value. Companies with strong balance sheets, stable cash flows, and long-term relevance are often sold alongside weak and speculative assets, not because they deserve it, but because investors are desperate for certainty. Mispricing emerges when short-term survival becomes the priority. Investors facing losses, margin calls, or liquidity constraints sell what they can, not what they should. Quality assets are liquid, easy to sell, and widely held, making them the first to be dumped in moments of panic. This creates a paradox where the strongest businesses experience the sharpest short-term declines, while their long-term fundamentals remain largely intact. The market, in these moments, is not inefficient by accident, it is inefficient by emotion. Another critical hook lies in the difference between price and worth. Price is what the market demands today under stress. Worth is what an asset can generate over time. During crashes, this gap widens dramatically. Earnings potential, competitive advantage, and strategic positioning are temporarily ignored, while headlines and sentiment dominate decision-making. For disciplined investors, this gap is not confusing, it is revealing. It signals opportunity hiding in plain sight. Mispricing also reflects a collapse in time horizons. Most participants shift from long-term thinking to immediate damage control. 5-year growth prospects become irrelevant compared to tomorrow's uncertainty. This short-term compression distorts valuations and creates windows where assets are priced as if recovery will never occur. History shows this assumption is almost always wrong, yet it reappears in every crisis, convincing new generations that this time is different. The investors who benefit from mispricing are not those who predict bottoms, but those who understand probability and patience. They recognize that buying undervalued assets does not require perfect timing, only conviction in fundamentals. When recovery eventually begins, valuation gaps close faster than they opened, and returns compound from levels that were only available during moments of widespread fear. The final hook is psychological, not financial. Mispricing exists because most people cannot emotionally tolerate uncertainty. Rational valuation requires calm, and calm is rare during downturns. Those who train themselves to analyze rather than react gain access to opportunities others cannot even see. In that silence between fear and recovery, when prices no longer make sense and confidence has evaporated, markets quietly offer their greatest rewards to those who understand that mispricing is not a flaw of the system, but a signal for the prepared. One of the most underestimated forces in economics is the cost of doing nothing. In periods of uncertainty, inaction feels safe, even responsible. People convince themselves that waiting on the sidelines protects them from loss. The hook is this: inaction is not neutral. It is a decision with consequences, and during market downturns, it is often one of the most expensive decisions an individual can make. When asset prices fall sharply, the immediate focus is on losses already realized, not on gains yet to come. Fear reframes opportunity as danger. Investors wait for clarity, confirmation, or the perfect moment, unaware that markets never offer certainty at discounted prices. By the time confidence returns, valuations have already adjusted upward, and the opportunity has passed quietly to those who acted earlier under uncertainty. Opportunity cost becomes most visible only in hindsight. Assets acquired during downturns often deliver outsized long-term returns not because they were risky, but because they were purchased when expectations were extremely low. Choosing not to invest during these periods means forfeiting years of compounded growth. The market does not penalize hesitation immediately, it does so gradually, through missed appreciation that can never be recovered. Another critical hook lies in asymmetric outcomes. The downside of disciplined investment during downturns is often limited by already depressed prices, while the upside is magnified by recovery and growth. In contrast, the downside of inaction is hidden but permanent. Capital that remains idle does not participate in recovery, innovation, or expansion. Over time, inflation, currency depreciation, and rising asset prices erode its real value, turning perceived safety into silent loss. Economic history reinforces this pattern repeatedly. The strongest market recoveries begin when participation is lowest and skepticism is highest. Those who delay action until optimism returns enter at higher prices with lower future returns. The crowd pays a premium for certainty, while early participants are rewarded for discomfort. This gap between fear and confidence is where opportunity cost quietly accumulates. The psychological dimension intensifies the effect. Humans are wired to avoid regret, and losses feel more painful than missed gains. This bias pushes individuals to wait until risk feels minimal, even though reward is directly tied to uncertainty. Rational economics favors probability over emotion, yet emotion dominates decision-making during downturns, amplifying the cost of inaction across entire markets. The most powerful insight is that wealth is built not only by avoiding mistakes, but by seizing moments when others hesitate. Markets reward those who understand that uncertainty is not a signal to stop, but a condition under which value is created. Those who fail to act during downturns may preserve capital in the short term, but they often sacrifice the very opportunities that define long-term financial success. Liquidity is the quiet advantage that determines who survives economic downturns and who controls the aftermath. When markets are stable, liquidity feels ordinary and unimportant. Cash earns little attention, and leverage is celebrated as efficiency. The hook is this: liquidity only reveals its true power when it becomes scarce. In a crash, access to capital matters more than intelligence, experience, or confidence. Those who preserved liquidity gain freedom of action while others are trapped by their obligations. Capital preservation is not about fear, it is about optionality. Investors who manage risk, limit excessive leverage, and maintain reserves are not retreating from opportunity, they are positioning themselves for it. When asset prices collapse, liquidity becomes leverage of a different kind. It allows investors to buy without pressure, negotiate from strength, and wait without desperation. Those without liquidity are forced into decisions they did not choose, often at the worst possible time. A critical hook emerges during periods of forced selling. As debt obligations remain fixed and asset values fall, highly leveraged participants lose control. They sell not because assets lack value, but because they lack cash. This is where liquidity transforms from a defensive tool into an offensive weapon. Cash-rich investors step into markets where competition has vanished and fear has replaced negotiation. Prices reflect urgency, not fundamentals. Preserving capital before a downturn also protects psychological stability. Investors with liquidity are less reactive because survival is not at stake. They can analyze opportunities calmly while others operate under stress. This emotional advantage is often overlooked, yet it directly affects decision quality. Panic leads to short-term thinking, while liquidity enables patience. In markets, patience is not passive, it is strategic. Liquidity also enhances timing flexibility. Markets do not move in straight lines even during recoveries. Opportunities appear unevenly across sectors, geographies, and asset classes. Investors with preserved capital can adapt as conditions evolve, rather than committing prematurely or missing opportunities entirely. This flexibility compounds returns over time because capital is deployed where value is highest, not where access is easiest. The deeper hook is structural. Wealth creation during downturns is constrained not by opportunity, but by access. Everyone sees falling prices, but only a few can act on them. Liquidity separates observers from participants. Those who prepared early do not need perfect forecasts, they need availability. Capital preservation ensures presence when it matters most. In every major crisis, the same pattern repeats. Liquidity becomes power, patience becomes profit, and discipline becomes advantage. Investors who treated cash as strategic rather than idle gain influence over assets, terms, and outcomes. Those who ignored capital preservation discover too late that opportunity does not wait for recovery. It rewards readiness. Economic crashes act as accelerators, not interruptions of long-term structural change. When growth is easy and capital is abundant, inefficiencies survive longer than they should. Weak business models are sustained by cheap credit, declining productivity is masked by expansion, and innovation competes with complacency. The hook is this: crashes do not create new trends, they expose which ones were real all along. What survives a downturn is rarely accidental. As capital tightens, markets become selective. Firms with strong fundamentals, adaptable leadership, and clear value propositions continue to operate, while those dependent on constant funding or speculative demand disappear. This process relocates resources toward productive uses, increasing overall efficiency within the economy. Labor, capital, and market share shift from failing entities to resilient ones, laying the foundation for post-crash growth that is stronger and more sustainable. Another critical hook lies in consolidation. During downturns, stronger firms acquire distressed competitors, technologies, and distribution networks at reduced cost. This consolidation increases economies of scale, improves margins, and strengthens market position. Investors positioned in these survivors benefit not only from recovery, but from expanded dominance. The crash quietly reshapes entire industries, often creating leaders that did not exist before the contraction. Structural shifts also accelerate innovation. Scarcity forces prioritization. Companies abandon marginal projects and focus on efficiency, automation, and scalable solutions. Technologies that improve productivity, reduce costs, or meet essential demand move from optional to necessary. This is why many transformative innovations gain traction during or immediately after economic downturns, not during periods of excess. Investor behavior mirrors these changes. Capital flows away from speculation and toward cash, generating assets with clear economic value. Valuations reset, expectations become realistic, and long-term growth narratives replace short-term hype. For disciplined investors, this environment provides clarity. It becomes easier to identify businesses aligned with future economic needs rather than temporary market enthusiasm. The final hook is perspective. While crashes feel disruptive in the moment, their long-term impact is often constructive. They remove friction from economic systems by eliminating inefficiency and rewarding adaptability. Growth that follows is not a return to the old structure, but the emergence of a stronger one. Those who understand this do not view crashes as pauses in progress, but as transitions that concentrate opportunity in the hands of those positioned for the next phase of expansion. So the real question isn't, will the crash happen? The real question is, who will you be when it does? Will you be frozen by fear or fueled by clarity? Will you follow the crowd or will you follow history? Let me close with this. Economic storms don't ask for permission. They don't wait until you feel ready. But they do offer something priceless to those who prepare leverage, ownership, and freedom. The 2026 crash is not a warning, it's an invitation. An invitation to think long-term, act rationally, and finally stop playing small. The next chapter of wealth will not be written in comfort. It will be written by those who stayed calm when others panicked, who saw opportunity where others saw collapse, and who understood that sometimes the path to getting rich begins when everything else is falling apart. Thank you.